our panel, we have three CFOs. ICR's had the pleasure to work with on IPOs before.
When I arrived, I had 20 people under me and 2 CPAs, which is not what you need to live life as a public company. And I think we really had to change the company's view on finance's role in the process. So I had to materially enhance and increase the skill sets on the team. So it's people, process, and systems. So I had to get a lot more of the right people. I had to put in all the right systems and checks and balances in place. I remember our CEO said at one point, he's like, yeah, we've been super efficient. I managed to avoid hiring a contract data entry specialist and a contract data checker. And I go, and that's why we are going public with 3 material weaknesses. So there's a lot of perceived inefficiency in finance, but really it's actually good governance. And then we had to put a lot of systems in place. We implemented Zora Financial to help us with automating our revenue recognition process. Now I can get revenue in 2 days, which is incredible when we're closing the books on a monthly basis.
They didn't bring me in to do an IPO. However, the following board meeting, May of 2014, the board decided we're going public. And Jeff, I want you to have the S1 filed in September. This was in May. So I had 4 months essentially to get ready for the IPO. We had to do 3 years of audit because we were using a firm, when EY came in, they weren't going to rely on the financials, so they had to go back and re-audit 3 years. So I started to have to think about what do I need in terms of readiness, in terms of be prepared. A bit of advice would be if you're thinking going public, that's why you're here, of course, make sure you have your internal control processes completely under control before you're up against that deadline.
And so we started that process pretty quickly, almost simultaneously with all the efforts of going public, to understand who some of the key hires would have to be, what some of the key processes would have to be as we went public. And then spent time looking outside of finance into the rest of the organization, going back to Isabel's point on key people, processes, systems, to see where weaknesses might crop up, what had to get fixed before we were public, what we could fix after we were public, and helping the organization understand the difference between casual sharing of information in a private setting and what could be MNPI shared at our sort of monthly all-hands meetings, and just getting the organization to think more about what it would be like to be in a public setting.
Certainly when you're going through a public process, there's an element of risk mitigation, right? Kind of what you were talking about with people aren't averse to risk, but they are averse to surprises. Then there's the uncertainty, which I think really impacts timing. That's when we talk about the election. It's uncertainty of the future, and whether you're going through a private transaction or an IPO, that's going to be a factor. And then there's what is your upside, your value creation after the event. I think what's really exciting to me personally is that a lot of companies exploring IPOs are running a dual track process, so they get a broader read on the market and the appetite through different routes. That does add an extra burden to your readiness because you are now exploring 2 very different types of transactions with different requirements. There can be some overlap, like forecasting and your corporate governance, your ability to report, whether it's going to be eventually to the SEC or if it's going to be to maybe a private equity owner or a large strategic corporation. Lots of overlap in that, but it does add some extra burden to that process.
I don't know that I'd say they prefer IPO. I think the optionality certainly is helpful. I think the cost of going through an M&A transaction, if they're just focused on that, will be less than going through the IPO process. And so it's all going to depend on valuation. So if they can get a valuation from an M&A transaction that's comparable to what they're talking about from an IPO perspective, I think they would probably lean more towards M&A. And we've seen, like, if you look at the numbers of how many transactions close in an M&A versus an IPO, it's certainly much more significant from an M&A perspective. But I think just having that optionality certainly gives some flexibility.
What, 15% was the average float sold in the IPO, so you retain a lot of upside if you only sell 15%. And then similarly, it's going to depend on your shareholder base. Like Viking was 85, 75% secondary, so that was the hedge funds who got it during the downturn selling out. So very, very fact specific. You know, a management team is not going to want to sell to a competitor. They'd rather go public and continue to be the management team. So really going to be fact specific.
So no one wants to get into an IPO process and then stub their toe and fail. So it's always good to have that dual track. The readiness is all there to be demonstrable in the submission. But really, you're talking about the application of D&O in those contexts where when you're talking about a D-SPAC in this environment where there's very little cash, they may not even make minimum cash coming through. There's no cash to hit the balance sheet concurrently with any raise, with any pipe or anything. Now, the idea behind D&O and indemnification becomes absolutely critical. You're talking about potential insolvency, right, in the first 12 months of the policy. When you're talking about M&A, you don't have that issue, so now you're focused on reps and warranties, and you're applying different cover. So you're not necessarily focused on D&O, you're more lubricating the transaction with transactional liability products. So again, it just depends.
Our esteemed panel discussion today on investor engagement in the private and public market.
I would say last year when we tried to softly reopen the IPO market, the growth at all costs had gone away in the name of profitability. I think what the current market is indicating to you right now is it's okay for a company that's not profitable to go public, but you absolutely need visibility into and line of sight into that profitability over time. I think where there's probably no tolerance right now is for a company that will not be anywhere near cash flow break even in the next 5 years. So that's one to keep in mind.
I'd echo what Matt said in terms of when I think about an income statement, a key metric, gross profit. I mean, there are certain things you can control when you're running a business. Gross profit is if you're not consistently hitting a gross profit margin that is similar or better than some of the public comps, then it's hard to make everything work from then on.
And then Prima, how does the Norges Access team manage ESG?
Sure. So as Philip mentioned, it's actually embedded within our investment process. So all the coverage portfolio managers are armed with the fact like they have to be on top of anything that's going on in that space. The reason being, we work for the people of Norway, right? We're investing their sovereign wealth. And so as a culture, they're very invested in ESG matters. And so it has to be a part of all of our investment processes. So when it comes to meetings, our portfolio managers will also be a part of those meetings as well. It's not a separate ESG team taking those meetings. And then we'll also have our stewardship management team as well as a part of those meetings.
Perfect, thank you.
Okay, so quickly here, I'm going to introduce these guests briefly. So as I mentioned, Karen Snow, who's Global Head of Listings here at Nasdaq. We have Craig DeDomenico, who's a Managing Director at Stifel. And of course, we have Steve Parrish, who is a partner and the co-head of ICR Capital. So Karen, tell us what we're looking at here. This is the Nasdaq IPO Pulse, and I think that's looking bullish. Can you tell us what we're seeing here?
Yeah, the most bullish that it has shown in the past 2.5 years, actually. So this is an index that we decided to create and publish earlier this year, and it is really meant to be used by the street as an indicator of when it is a good time to bring a company public. And what we did is we back tested 50 different factors and came up with the 6 most relevant on a go-forward basis. So we have really like a 6-month visibility or level of confidence on a go-forward basis.
And we've also done an analysis of IPO activity, and we actually focused more on presidential election years. And interestingly, we got the same conclusion as Karen did for the broader election universe, that in the last, I think, 7 or 8 presidential election years, activity in the Q4 was actually greater in presidential election years than in non-presidential election years, which was initially a bit of a surprise to us. And there is a little bit of pull forward in October versus November, but then December was probably slightly more active than it is in a typical election year. So we've been sort of advising issuers who are contemplating accessing the market later this year that, yes, it's probably tricky to be in the market the first 2 weeks of November, but the IPO market, in Q4 is open and just need to navigate around, the election.
Yeah, I think to quote one of my favorite songs, the waiting is the hardest part. I think a lot of this activity we're seeing this year is deferred backlog, most of it coming out of our private equity sponsor and VC community that generally makes up, call it 2/3 to 75% of the IPO calendar. And it's finally time for, them to monetize and push some companies forward. We think obviously what's driving, as Karen said, is obviously the interest rate cycle finally playing ball, but as importantly and more importantly, companies' ability to project right now. And obviously the ability for IPOs to get done have a lot to do with practitioners like us on the panel being able to help companies think about their next 12 to 24 months and investors being confident with that.
I think for the key consideration for companies are preparation and execution from my CPA point of view, in a way that now these companies from overseas, they need to comply with security laws, US security laws. They need to comply with US regulation. They need to comply with US reporting requirement. They need to comply with the Nasdaq listing requirement and the SOX, etc. Right? So I think that key consideration for companies that from overseas are trying to list on your stock exchange is really try to get ready, okay? And they cannot do it by themselves. I think the suggestion that I usually give to companies is surround yourself with professionals, right? And they have done that before. They have experience with international law and regulations.
From our standpoint, I think a lot of it is education, to be quite frank. We're spending a lot more time really speaking with corporates of all sizes. It can be multi-billion-dollar companies. It can be companies that are under 100 million. And it's really the education factor, to be quite frank. And then also, if you're the corporate that's operating, in a region outside of the U.S., it's always been, what if? Can I? We can't qualify or, for the U.S. to list on Nasdaq or New York, or, what will investors think?
It's interesting. In Canada, our capital markets, I think, have always played a little bit behind yours, but we are now seeing some really significant sponsor-backed companies getting prepared for an IPO for the first time in years. I've just started on a couple of them myself, and they seem to be, we've got a great tech ecosystem in Canada, but as you, Jay, mentioned, that's sort of not where the action is right now. It seems to be in sort of the more industrial consumer type, bigger EBITDA positive businesses that are preparing to come, and certainly, as I mentioned earlier, interest is very, very high in seeking a US listing as part of the IPO process.